In this video, we will discuss why time is so important for trading and building trading strategies more generally. Stick around to the end to learn how time and time-based strategies can massively improve your trading. This video is sponsored by Prosperity Algo and our free Golden Time Bomb Expert Advisor. Do you want to make 100+% annual returns through automating the London breakout and the opening range breakout? Then click the link in the description. So there seems to be nowadays quite a few almost conspiracy theories floating around the internet on how the markets are timed and how everything kind of happens on schedule. And at least in my opinion, that doesn't make a ton of sense. However, time as a variable for trading strategies is still exceptionally important and is a very powerful tool to build edges, simply because many market events are really based on time. And in this short video, I wanted to go over a few of them, specifically market opens and closes, as well as just office hours more generally. Also talking about certain types of orders and rebalancing of ETFs in different portfolios, and then finally ending on high impact news. And this is why some of the best expert advisors which you might find are actually time-based, because there really is a strong, powerful, fundamental driver behind them. So kicking ourselves off here, I actually pulled a few screenshots from a couple different or 3 different stock markets just to show you guys the concept of different market opens. So especially in Forex, we often think that you're able to trade 24/5 or in crypto 24/7, but many markets, in particular equity markets, still have very defined trading times. So the New York Stock Exchange, true core trading session is between 9:30 a.m. Eastern Standard Time and 4 p.m. Eastern Standard Time. And then London here we have 8 a.m. to 16:30 British time, as well as for Japan we have 9 a.m. to 11:30 with a break, and then 12:30 p.m. to 3:30 p.m. So what this shows is that every single day, there are clear time-based events which influence the market, because certain orders execute when the markets open. Certain participants only trade once the markets open and not during pre-market or 24/7 or 24/5 trading hours. So these very defined moments in time have an incredibly large impact on the global flow of funds. And even if you trade Forex or if you trade commodities, equity markets still have a pretty big impact on you, just because a lot of the same participants who trade equities also trade Forex and commodities. So perhaps at a certain time of the day, they decide to allocate money to equities and they need to sell commodities to be able to actually move that money around. And because there tends to be a lot of correlations, or be it either positive correlations or negative correlations between all of these major markets and Forex, commodities, etc., there is an impact of these defined times even on more CFDs and Forex. So really the takeaway from this is every single day there are certain periods of time which influence the markets, be it opens and closes. So being able to build strategies around these opens and closes can give you a very strong edge, because they're based on something really real and really concrete. Another really interesting point is to discuss our office hours more generally. And I know a lot of people nowadays will tell you that the majority of trading is done algorithmically, and in certain asset classes that is 100% true. I think last time I checked, equities were close to 90%. But the thing is, even many algos in an institutional context still require supervision. Many large hedge funds or market makers, they won't necessarily just run the algo and go to sleep. They'll have teams 24/7 or during given time periods in order to actually monitor the algorithms. So because of that, and because of the fact that many orders are placed during business hours, the simple fact that in certain countries business hours are occurring will also influence the markets. And one point I wanted to make here is that, especially in commodities or in Forex, the largest participants are often not speculators, not even big speculators like hedge funds. They're actually just people who are producing or selling or using the underlying commodity or the actual currency pair that is there, right? And to illustrate this point, I wanted to show this quick pull from the Commitment of Traders report, which shows the different positions held by various participants in futures. And this particular chart is from gold, but you can pull the exact same thing for any future, or including currency futures. What you can see here is that the largest positions are actually held by the commercials. So these would be the producers, merchants, processors, and in gold, this is probably actually the smallest percentage of other commodities. I would venture if you were to check copper or nickel, it would be even higher by the actual producers. And in the same thing with currencies, the largest buyers of euros are likely not speculators or are not speculators. There are people who actually need euros in order to conduct their business. Like when Coca-Cola wants to pay somebody in Germany, they need to transact US dollars to euros. So these represent probably the largest percentage of the actual trades which are made in both commodities and currencies daily. And the takeaway there is that many of these large users, be it of commodities or currencies, are not trying to get the best price. They're just trying to transact to be able to keep going on their business. And because of that, they tend to put through orders when, not at bad prices, but generally speaking, when it makes sense for them. So when the hedging team at Coca-Cola wakes up in the morning, they will go and they'll put their orders through. Or if you're part of the sales desk at Barrick Gold or Kinross and you're trying to actually secure forward sale contracts, you will do this, generally speaking, at your working hours. So because of that, there's a huge element of people's working hours also playing into how the markets move. And you will see flows coming online at given times corresponding to just when people are actually starting to work. So this kind of goes aligned with why office hours also make time such an important element of the markets, because both algorithms require supervision, especially in more of an institutional context, and because a huge percentage of the funds and the flow of funds and orders more generally are just done when it is convenient for the actual people who work in these businesses who transact in large amounts of commodities or currencies. And moving on here now too is a couple other elements as to why time is so important is market on open orders as well as just ETF rebalancing. So starting off with market on open orders, many orders are actually placed to execute upon market open. So this kind of ties into the previous point about why market open and closes are so important. There's also market upon close orders, which are a different type. And why this is important is many strategies can be based on the initial spike which happens at market open. And the reason for this spike is completely logical in that many orders are simply waiting to trigger upon market open. This is particularly powerful for equities and equity indices, but also to a lesser extent affects gold and many commodities just because of the correlation between assets as previously mentioned. So a lot of these impulses which happen at the open aren't just done because of some sort of probabilistic or correlated reason. It's no, there's very much a fundamental reason behind it, that there's tons of orders pending and waiting to trigger at the open, which are timed orders. And that's one of the things that makes time so powerful. I also wanted to touch on rebalancing, and many ETFs, many funds, many futures, or not futures, funds need to be rebalanced fairly frequently in order to make sure that they are tracking whatever they are pegged to. So in the case here of the GLD ETF, it is an ETF which is traded on equity exchanges, which tracks the spot price of gold. This ETF needs to be constantly rebalanced to make sure that it is matching whatever the spot price is. This ETF will be rebalanced at given time intervals or given time periods, right? So the fact that this ETF would rebalance at a given time would directly impact how the price of gold would move, because if they're putting in billions of dollars or hundreds of millions of dollars into the gold markets, that will also have an impact. So yet another reason why time is just so important. And finally, I wanted to touch on high impact news. This goes without saying, there are high impact news events which occur every single day or most days, or high or low or medium impact news events which occur most days. And the thing is, these events have obviously a direct impact when they actually occur, but also influence participants before or after the event. People might, for instance, be waiting to deploy money until after NFP because they don't want to be at risk during the actual news event. So because these events are all timed as well, that in turn affects how the markets behave on a time-based basis. So it's another extremely powerful aspect. So to kind of wrap up today, the reason why time is so important is there's all these fundamental events which happen based on time. And because that's the case, you're able to build strategies to exploit that. And this is why opening range breakouts, for instance, are such a powerful trading tool. Hope you guys enjoyed this video, and drop me a comment if you have any questions.